1. Early money. Before money even existed, people lived in small communities and met their needs by trading goods with one another. Since these communities were small, everyone could more or less remember who had given what and who had received what. This made it easy to keep track of who owed something and who was still owed. As time passed, communities grew larger and trade became more frequent. People started producing more for the benefit of society, and once rulers began collecting taxes, keeping track of all these transactions became much more difficult. IOU notes seemed like a good solution to this problem. However, if you didn't know the person who issued the note, it was hard to trust it. Because of this, people began using valuable objects such as whale teeth as a medium of exchange. This allowed people to trade not only with those they knew, but also with strangers. They could also save their purchasing power for future use. In short, as money emerged, the concept of debt became an important part of economic life as well. 2. Metal money. As people started using seashells, barley, feathers, whale teeth, and other objects as money, it became clear what qualities good money should have. For example, barley was heavy and difficult to carry, and it didn't last very long. Whale teeth couldn't easily be divided into smaller pieces, making them impractical for small transactions. Seashells were found in many places, so they weren't considered scarce enough. Feathers, which had little intrinsic value, were also unreliable for trading with other communities. Another important fact was that people with a lot of money had more power, and that power often helped them become even wealthier. Because of this, kings began minting coins from precious metals. They stamped the coins with official markings that guaranteed their weight and value. Metal coins were durable, portable, and valuable in their own right. As a result, they became a trusted form of money for trade between different societies. However, over time, some rulers sought to increase their wealth by reducing the amount of precious metal in the coins or mixing in cheaper metals. As a result, the actual value of the coins gradually became lower than their stated value. 3. Paper money carrying large amounts of metal coins was difficult and inconvenient. To solve this problem, Chinese rulers began storing heavy coins in secure places and issuing paper certificates that represented them. This system made long-distance trade much easier. Although the paper itself had no intrinsic value, people trusted what was written on it. They knew they could exchange these certificates for gold, silver, or the coins they represented whenever they wished. As global trade expanded, paper money became increasingly popular. However, merchants and lenders worried that printing money was too easy. To make the system more reliable, they tried to link the value of money to gold. For many years, the gold standard served as a common measure of value between different currencies. However, as economies needed more flexible exchange rate systems, the gold standard eventually proved unsustainable. By the early 1970s, the world had completely abandoned the gold standard. Today, the only thing that truly distinguishes a banknote from an ordinary piece of paper is the trust people place in it. 4. Controlling money. Many years ago on Yap Island in the Pacific Ocean, people used large stone discs called rye stones instead of gold as money. When the island chiefs made it mandatory to pay taxes with these stones, rye stones became the official currency accepted by everyone. As a result, control over the money supply fell entirely into the hands of the chiefs. The most valuable rye stones were so large and heavy that no one actually moved them. Instead, only their ownership changed. Over time, people began using these stones as collateral and issued promissory notes based on their value. This practice is considered one of the earliest forms of banking. Later, when the chiefs started accepting these promissory notes instead of the stones themselves for tax payments, they gradually lost control over the amount of money circulating in the economy. During the 20th century, some economists argued that the amount of money circulating in the economy has a direct impact on economic performance. For this reason, they believed governments should control the money supply. However, since most of the money in circulation today is created by private banks, doing so is far from easy. 5. Money and inflation. In the 16th century, Spain brought back enormous amounts of gold and silver from its colonies. At first, people believed this would make the country wealthier. However, merchants responded by raising the prices of their goods, and the expected benefits never materialized. Those who owned the newly imported gold were no better off than before, while those without it experienced an even greater loss in purchasing power. The only group that truly benefited was debtors, because inflation reduced the real value of what they owed. This event is considered one of the earliest examples of the idea that too much money, chasing too few goods, leads to inflation. On the other hand, if people save more money or if production increases at the same pace as the money supply, inflation may not occur even when the amount of money grows. 6. International money. In the 18th century, Britain required its American colonies to pay their taxes only in British pounds and prohibited them from printing their own currency. As a result, the colonies had to trade with Britain in order to obtain pounds. According to Benjamin Franklin, one of the main causes of the American War of Independence was the heavy British taxation and the unfair monetary system that placed the colonies at a disadvantage. After gaining independence, the United States introduced its own currency, the U.S. dollar. Thanks to America's strong economy and growing influence in international trade, the dollar gradually became the world's leading reserve currency. Britain, along with many other countries, began holding a significant portion of its reserves in U.S. dollars. In doing so, Britain effectively transferred part of its monetary influence to the United States. 7. Money and the development of banking. By the 19th century, banking had become a trusted and respected profession. Banks made profits by paying lower interest rates to depositors while charging higher interest rates on the loans they issued. Eventually, banks realized that not all customers would withdraw their money at the same time. As a result, they began lending out far more money than they actually held in reserves. This system is known as fractional reserve banking. Occasionally, when everyone tried to withdraw their money at once, bank runs occurred, affecting not only the banks themselves, but the entire economy. To reduce this risk, governments introduced deposit insurance to protect customers' savings. In 2007, however, banks such as Northern Rock had financed many of their loans not with customers' deposits, but by borrowing from other banks. As a result, the financial crisis became far more severe. 8. Money and saving. Following the global financial crisis of 2008, economists emphasized that there are two different types of money in the economy. The first is money created by banks. Whenever a bank issues a new loan, it effectively creates new money. At the same time, the borrower assumes the obligation to repay that loan. The second type is money created by the government. Governments can create money by issuing bonds. In this case, the resulting debt belongs to the public sector rather than to private individuals. During the 2008 financial crisis, governments used this method to purchase troubled assets from banks and prevent the financial system from collapsing. As a result, the private sector remained financially stable, while the cost was reflected in higher public debt. 9. The power of money. Although the gold standard officially came to an end in 1973, the U.S. dollar continued to dominate international trade. After the 2008 financial crisis, the United States announced trillion-dollar rescue packages, leading many people to believe that the dollar would lose its value. However, even years later, those expectations did not come true. The main reason is that much of the world's wealth is still held in U.S. dollars, and people continue to trust that the dollar will maintain its value. This shared confidence remains one of the strongest reasons why the dollar continues to be a powerful global currency today. 10. The future of money. There was a time when coins and paper money represented the most advanced payment methods available. Today, however, only a small percentage of transactions are made using cash. Credit cards and electronic banking now allow money to be transferred anywhere in the world within seconds. Advances in digital technology have also led to the creation of new forms of money, such as Bitcoin, Linden dollars, and other cryptocurrencies. These digital currencies possess many of the key characteristics of money. They are durable, portable, divisible, difficult to counterfeit, and have a limited supply. However, as long as governments do not accept taxes in private currencies like Bitcoin, and banks do not widely issue loans in these currencies, they are not fundamentally different from earlier forms of exchange such as whale teeth. A clear sign that a new form of money has become truly significant will be when governments and banks begin trying to regulate or control it. And as long as governments and banks continue to control money, people will keep asking the same question: what will they use that power for?